Close your account now. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story, they get ready to pay as a major retail bank CEO is warning all 86 million of its customers that new fees are coming. And as you're about to see, they're not the only major bank that's threatening to impose fees on every single one of its customers, because the problems for the major banks are starting to line up as delinquency rates rise, bankruptcies rise, and loan growth slows. But many people say the Fed will run to the rescue with a few rate cuts, as we'll show you why rate cuts at this point is the worst possible news the banks can have. Plus, we have a sponsor of today's show. We'd like to welcome Aduro Clean Technologies back to the show. You can find them on the CSE under symbol ACT and on the OTCQX under symbol ACTHF. And this is a stock you want to look up right now, because if you're a technical trader, you understand volume, and what's happening right now is the stock is breaking above its one-year volume profile line, setting up to shoot the stock higher about 10%, and under heavy volume could send it even higher. This is one you want to jump on quick. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to Wall Street Journal, where we pick up this exclusive story as JP Morgan warns its customers, prepare to pay for your checking accounts. And this is something that customers have historically had for free, because as we know, banks earn money on deposits, but now we're starting to hear rumors right from the top of the bank that they're looking at imposing fees on every single account, and they're not the only bank that's looking to do this. And here we see Chase is planning to pass on the cost of higher regulation and charge customers for a number of now free services, including checking accounts and wealth management tools, if the rules become law in their current form. She expects her peers in the industry will follow suit. And these changes will be broad, sweeping, and significant. The people who will be most impacted are the ones who can least afford to be, and access to credit will be harder to get. And yes, can you imagine the people who are already marginal to begin with are going to start paying a service fee to maintain an account at a bank? What you're going to see is an exodus of banking customers, and this is already a challenge right now, because people like the Federal Reserve want to see more unbanked people have accounts. And when the banks start levying fees, you're going to find people looking to carry cash in a major way. And this isn't the first time banks have said they would pass on higher costs to consumers when regulators have attempted to cap their fees. Back in 2010, after the post-financial crisis overhaul of bank regulations, lenders warned that they would levy fees on debit cards because of a cap on some card charges, but few ended up doing so because consumers threatened to move their business. Some consumer advocates say this time is no different. And I want to know, weigh in the comments, if your bank actually starts imposing fees on checking accounts, are you going to move your money? If so, where are you going? Let us know, because the banks say their only option now is to pass on their costs to their customers, but that's not true. This from the president of Better Markets and Economics think tank. He says yet again, banks are dressing up their attempts to maximize their own profit under the guise of what's good or bad for their customers. But if we want to talk about maximizing profits, check out the stock on our sponsor today show, Aduro Clean Technologies, on the CSE under symbol ACT and on the OTCQX under symbol ACTHF. Here you can see this one-year volume profile line, and what this means is everybody underneath here over the last year, the sellers, they're about to get squeezed. And you can see in today's trading, the stock is breaking through here, setting up an initial move to $1.12, and that could break out even higher, potentially to $1.27 or more if there's enough heavy volume trading here. Be sure to check out the pinned comment or description, or stay tuned to the end of the show for further information. Now let's take a look, as the banks are saying that it's going to get even harder to lend, and this is dangerous, because in a debt-based economy, there's something critical you need, and that's people borrowing money. That's what creates new money in the economy. Now the banks are saying not only do you have to pay fees, but we're going to make it harder for you to borrow. And new bank capital rules will make it harder for banks to lend by requiring them to hold on more reserves against mortgages and credit card loans. And what reserves are just money in place in case of default. The banks have to, of course, cover those losses. Now, the issue here is whenever there's a problem in the banking system, you'll hear from the regulators and the Fed, there's only one and always one solution is, well, banks need to hold more reserves or more cash for emergencies. And what happens happens is this is just a backdoor way to get the banks to buy more U.S. government treasuries, because that's typically how they hold their reserves, as government debt. And banks are saying if the government passes these laws, well, you're going to want a loan, and they're going to probably say no. And the highly competitive environment for retail deposits means that banks might end up needing to keep their services for free, no matter what the final rules may end up looking like, because there is a potential exodus where customers may flee banks charging fees and go to banks that are not. Of course, again, weigh in the comments, what are you going to do if your bank starts to charge you? Most customers can access retail banking easily and seamlessly today. It might be disadvantageous to keep services at zero cost, but banks' hands could be forced by other competitors who will offer customers low-cost services, and there's no doubt this will be an opportunity for other banks who are looking to pick up some of JP Morgan's clients and perhaps even that of other banks, because the banks are facing problems here in a big way as their customers continue to feel pressure from higher interest rates. And again, this is something that's not just a bank issue, but it's a customer issue. And many people believe that higher interest rates would be a boom for the banks, because one thing they're doing is earning more money on deposits and still paying their customers less. But the other issue is believe that higher lending, of course, would lead to bigger profits. The challenge is customers are not looking to borrow at higher rates, indicating that financial conditions are tight and opportunities in the economy, well, they're not that many. And of course, this is an issue the banks are facing. As credit card loans rose faster than spending at all three banks, a sign that more borrowers carried over balances month to month, meaning people just don't have the cash flow here. So when people are carrying bigger balances, that means their money is not going as far due to inflation. They're being forced to put their expenses on their credit cards and pay even less, not bringing their balances down. And when you dig into what's happening across different consumers, the folks on the lower end of the wealth or income spectrum are struggling more. And this is only going to get worse when they're having to pay to have an account at a bank. And JP Morgan's credit card arm, the biggest in the country, said charge-offs on loans rose nearly 2/3 from a year earlier. The rise in part reflected a normalization from years of historically low levels, but the issue here is as you see charge-offs and delinquency rise, it's indication that the economy just does not have enough money, because in a debt-based economy, when you constrict the creation of credit and slow the money growth in the economy, what happens is eventually the music stops and debts need to be paid, and what you find out is there's not enough money to cover all those debts, leading some people into delinquency and default, forcing banks to deal with and cover the charge-off. But lower income consumers have started to shift spending to non-discretionary from discretionary purchases, which is historically a sign of weakness. And this is something we've seen from companies like McDonald's and Burger King, Taco Bell, Target, and Walmart, all saying that spending habits of their consumers are shifting in a major way. They no longer have the free cash flow. They're focused on not only value, but those non-discretionary items. And this is, of course, because you're going to see a problem for many businesses. Meanwhile, Citibank said consumers with lower credit scores were spending less and delinquencies were up, although we saw possible signs of improvement. By June, more were catching up on their payments, but the question is, will they be able to catch up before it's too late? I don't think they're going to, and let me show you why. Because when the banks constrict the creation of credit, again, we talk about how there isn't enough money in the economy to pay on all the debts, but particularly in times where banks are very restrictive, well, it means delinquencies have no choice to rise. And here you can see the net percentage of domestic banks tightening credit standards for credit card loans is shown in blue. And at a time when, of course, we see total compensation growth slowing, inflation is still maintaining elevated levels, we see energy prices rising, we see insurance costs rising, consumers are looking to short-term credit cards to keep their finances afloat. But what you'll note here is as that, of course, blue line goes above the horizontal black line, suggesting on net banks are tightening standards, making it harder for consumers to get credit cards, get their limits up. What happens, you see the delinquency rates here. Now, this is shown on a quarterly basis in red. What you see is it rises during those periods, and you see it happen again going into the global financial crisis. And now we don't have the most recent data yet, but what we can see is rising delinquency rates because banks have lending standards tight here. But everyone believed that if the Fed were to cut rates, things would get better. I'll show you here in a little bit why that's not the case, because one of the problems that banks are facing is bankruptcies are starting, and that means more debt is about to get charged off. As most businesses that failed this year come from one sector of the economy, you want to take a guess at what that is? There were 346 companies that filed either liquidate or reorganize through bankruptcy in the first 6 months of the year, the highest half-year level since 2010 when there were 467 filings. Just last month, 75 companies filed for bankruptcy, which is the biggest monthly total since the year of 2020, and the majority of businesses that gone belly up are considered consumer discretionary. Absolutely no surprise here. A broad category of firms that sell goods or services to people that don't need them every day, such as restaurants, clothing stores, and car dealerships. Most of the businesses are also considered small or mid-sized because they don't have the cash or access to credit that other larger businesses do. And this is an issue because this is going to impact the banks. You want to talk about what brought the banks down during the financial crisis is the fact that people couldn't pay their bills. What we're seeing is the second longest contraction in bank credit in history, all due to the Federal Reserve inverting the yield curve. This means that at some point, the amount of delinquencies and defaults is going to accelerate in a major way. And consumer demand has also been underwhelming so far this summer, according to the Institute of Supply Management's latest survey. The latest spending data and comments from retailers in recent months have also demonstrated that U.S. consumers aren't splurging this summer, unlike last year, and instead spending more cautiously. And this is something I raised a red flag about because in the summer months, this is where discretionary businesses make a lion's share of their business out when people are traveling and spending, and they need that revenue to get through the lean winter months. This is a big problem for the economy at a time when we should see it booming. And of course, we know that there's a problem when consumers enter delinquency. Of course, that means they're not going to get more credit. And what happens, they start to cut their spending. Here you can see the delinquency rate on credit cards still shown in red against advanced retail sales is shown in blue on a year-over-year rate of change. And what we notice is as delinquency rates rise, what happens is retail sales growth decelerates. You see that again heading into the dot-com bubble. Once again, during the global financial crisis, you note that as delinquency rates spiked, retail sales absolutely plunge, and there is an absolute correlation right now. We see a continued decline in retail sales at a time when many experts say that retail sales should be rising, but you'll note a rising delinquency rate says consumers already know there's no way they can get more credit as they already can't even pay on the stuff they bought, and that is a huge problem. And this is all troubling because the summertime is a crucial season for many kinds of service-producing businesses. Last month alone, an arcade and hotel management company filed for bankruptcy, according to S&P Global, citing supply chain issues as another possible reason behind the run-up in business bankruptcies. How about here's another one? The economy just is running out of money, and that is the bigger issue. If these companies could access the credit markets, they might stay afloat. If consumers had more money, they would probably be out spending it. But then what we have is, again, an economy that is being constricted of credit. But and this might not be the omen for future economic pain, although I believe it is. It could be just an unwinding of pandemic-related distortions. And it is absolutely an unwinding of pandemic-related distortions because what we did is we pumped the economy full of money through easy credit and direct transfers from the government to consumers. Now it's all gone, and ever the government believes that the economy will stay at its current run rate. Reality is it has to come crashing back down, not just to its prior level, but below that, and we're seeing early signs of that. But yet many people again believe that if the Fed just cuts rates a couple of times, everything will be okay, but perhaps it won't. As rates cut could make things worse for banks before they help, and that is the case that we've been making. That rate cuts are not the holy grail that everybody thinks they are. The transition to the world could get rocky as the first small decline in rates probably won't by itself stimulate a huge amount of new lending. In fact, it unlikely will actually stimulate any lending. I'm going to show you why rate cuts are actually terrible news for the banks. And yet it will start to eat into the bank's interest earnings on their cash and floating rate loans tied to benchmark rates like credit cards and corporate revolvers. And a lot of their depositors are probably still going to be looking for a good return on their cash. The problem is depositors are going to be looking to flee when they find out they have to pay the bank on top of everything else to keep their money there. If we take a look at commercial industrial lending, this is the weekly data shown on a year-over-year rate of change in blue. And while everyone believes that the narrative that rate cuts are really stimulative for the economy and will drive people to borrow, history actually says just the opposite. Here you can note, looking at the federal funds rate in red, as the Fed begins to cut, this should actually be a boom for lending. What do you see? A deceleration in lending into an outright contraction below that horizontal black line into the early 90s. Again, this happens ahead of the dot-com bubble. The Fed cuts rates and lending collapses again during the global financial crisis. Leading into the pandemic, it happens again, and this time we can already predict, because lending is just slightly positive on a year-over-year rate of change, but if Fed looks to cut, look for an absolute collapse in lending, and that is the only sign that you need that says the economy is headed into recession. Because while the Fed is trying to maintain the view that they over-tighten and just need to back off a little bit, historically says when the Fed cuts, it means there's problems in the economy. They don't just cut once or twice, they aggressively cut in a major way. As banks can escape the squeeze and add more dollars overall to their earnings if they're growing their loan books. But as I just showed you, that doesn't actually happen because big corporate borrowers are still acting cautiously. In the case of commercial real estate loans, some banks may actually be looking to shrink those books for now, hoping that construction fraudsters find permanent financing elsewhere. The borrowers will put up a lot more equity and get smaller loans when they refinance. The problem is, of course, we know borrowers don't have that kind of money. We know buildings are going empty, and it's only going to get worse as more people hit the unemployment line. We know that commercial real estate is going to devastate the small and mid-sized regional banks at a time when the big commercial banks are looking to charge their customers. Where will people go? I don't know yet, but I'd love to see what you have to say. Again, keep weighing in the comments, because look at this. You want to talk about what the damage the Fed is creating to the economy. It's the inversion of the yield curve. And here we see the 10-year, 2-year. And when it's inverted, it means 2-year rates are higher than 10-year, which is absolutely unusual and abnormal. This is a man-made construct. And right now, we're at the second longest inversion in history. And despite the notion that when the Fed cuts rates, that this will be bullish for the economy, what you see is the red line steepens, and that indicates that interest rates are falling. And notably, when interest rates fall, what happens with banks? They further tighten lending standards. We see that very clearly in the dot-com bubble. We see it again in the global financial crisis, and they're likely to tighten more now because what happens is interest rates fall. The issue is they're making even less money, and they're doing it at a time when the economy is slowing. There's an increase in delinquencies and defaults, and the banks say, you know what? We'd rather not lend you money right now because we're not sure if we can get it back, and we're not making enough on the interest rate spread. In fact, we're not making hardly anything to cover the potential risk of loss. So banks make it even harder to get credit. But one place we think there's a huge opportunity, and that is the stock for our sponsor of today's show, Aduro Clean Technologies. You can find them on the CSC under symbol ACT and on the OTCQX under symbol ACTHF. Let's look at some of their recent press releases, and we'll take a look at the chart setup because it is absolutely impressive. Aduro, they are the power of between what is complex and what is simple, and they are a developer of patented water-based technologies to chemically recycle waste plastics, convert heavy crude and bitumen into lighter, more valuable oil, and transform renewable oils into higher value fuels or renewable chemicals. The company's hydrochemical technology relies on water as a critical agent in a chemistry platform that operates at a relatively low temperatures and cost. This is a game-changing approach that converts low-value feedstocks into resources for the 21st century, and this is starting to get the attention of Wall Street in a big way. The stock is breaking out right now. You don't want to miss out on this. Here we can go back to May 16th. Let's check out this press release here where we see they're pleased to share some exciting results from a preliminary test that achieved deconstructing cross-linked polymers using the company's hydrochemical technology. Let's take a look, because what they did is they went to, of course, their client, and they provided a sample of cross-linked polyethylene, or XLPE, a waste stream from its local production facilities, in which Aduro investigated the application of its proprietary technology for chemical recycling of this difficult to recycle material. And they were excited to report promising results from the preliminary test with yields up to 84% of lower molecule weight hydrocarbons, predominantly in the C8 to C20 28 range. These results confirm the effectiveness of ACT in breaking down complex polymers like XLPE, which have high thermal stability and complex decomposition pathways, into valuable hydrocarbons, setting up Aduro to be a major player in the recycling market here. And you can still get in early on this. The milestone confirms our preliminary assessment that we can provide customizable solutions tailored to industry-specific requirements. We're able to transform XLPE waste into high-quality liquid hydrocarbons with an impressive conversion yield, enhancing the material's life cycle and providing a reliable feedstock for refineries. This development addresses a critical challenge in the industry and opens up new avenues for sustainable material management. Let's take a look at the stock because we're talking about how it's breaking over that one-year volume profile. Let's go back to the setup here late in June, that is. You notice this is the 10-day chart, and what you see here is a bunch of volume came back in here late last month, and buyers stepped in and bought into the stock in a big way and started to send it higher. And what's really interesting is you see that the buyers continue to support the stock as sellers look the other way. Here we're now seeing the 30-day volume profile. The stock moved through it nicely and continued to rally right into the supply zone. In this zone right here, you see these two horizontal purple lines. This was actually a very critical zone because sellers were at this level over and over again. And as you saw on that one-year chart, they started to break out and looking to catapult Aduro stock up. We think could be 10%, could break out even higher if there's a large amount of volume behind this stock. And here you can see on the 90-day chart, there is that volume profile line. You can see here why this is so critical, because every time it got around this level, sellers jumped in here in a big way. But what happens is, you know, it can break out to this $12 and even higher here. This is why a big push behind Aduro stock. If we see a lot of volume and a lot of trades come in, it could catapult their stock to highs that they have not yet seen in a very long time. And this is a big opportunity. Again, you can find them on the CSE under symbol ACT, on the OTCQX under symbol ACTHF. Remember, this is a quick one. You got to get in because they just joined a delegation at an intergovernmental negotiating committee on plastic pollution. Of course, you can imagine governments are going to be very fixated on technology that looks to clean up anything in the environment. And here we can see they had one-on-one discussions with industry delegates to promote its hydrochemical technology, or HCT, and this efficiently breaks down complex waste streams into valuable chemicals. The technology is particularly suited to handling types of waste plastics traditionally considered non-recyclable, addressing a key topic at the event. And these negotiations at the Inc. 4 come at a critical juncture for both the world and Aduro. The public and their representative governments are demanding real action from plastic producers to improve how plastics are made, used, and managed. This global attention, supported by the backing of the United Nations, the private sector, and financial institutions, bodes well for companies like Aduro. With this technology platform at the foremost of innovation, Aduro is addressing many of the critical issues that contribute to today's low recycling rates for plastic waste, setting up Aduro to be a leader in this space and one that you can take advantage of right now. Again, on the CSE, under symbol ACT, on the OTCQX, under symbol ACTHF. Don't miss out on this breakout opportunity. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.